Okay, we're right at 2:01 Central. It's October 19th. Thank you for joining us. I'm Skylar Wynand, founder, CIO at Regan Capital, and we're pleased to present today's webinar, which is exclusively focused on our mutual fund, Regan Capital Total Return Income Fund. RCIRX is the institutional class. RCTRX is the individual class. We're now on most major platforms. We just hit our 3-year track record here on October 1st. Pretty good returns. We'll talk about that in a little bit. But we haven't had a mutual fund specific webinar in a while, so we're pleased that you all could join us. Regan Capital, we're just at about 1.1 billion in total AUM. We've been around since 2011. We're Dallas based. We also offer 2 limited partnerships, managed accounts for family offices, endowments, insurance companies, and our 40 Act fund, which is the topic of today's webinar. My background's here. A lot of people on this call know me. Chris Hall is the other senior PM. I've been in the business for 22 years. Started at GMAC RFC, which was Residential Funding Corporation, which was owned by General Motors out of college 22 years ago. Was on the buy side for a total of about 6 years. Worked at Cantor Fitzgerald from 2007 to 2011. Was in charge of all non-agency mortgage bond trading, and started Regan here 12 years ago, August of 2011. Quick overview of our focus. As a firm, about 1.1 billion, we're almost exclusively focused on the residential mortgage-backed securities market, okay, which is the biggest fixed income market in the world next to U.S. Treasuries. So U.S. Treasuries are about 24 trillion. MBS is $12 trillion, bigger than investment grade, high yield, and bank loans combined, and 3 times the size as the United States municipal bond market. A good portion of our focus historically have been on what's called legacy mortgage bonds, which are bonds that were issued in 2007 and earlier. Primarily 05, 06, 07, there was a tremendous amount of issuance, which ballooned the non-agency market as a whole to about 2.2 trillion. Non-agency currently is about $1.5 trillion of that 12 trillion. But the legacy book, which these are loans and borrowers that have been in their homes for 17 plus years. They have over 60% equity in their home right now on average. Most of these borrowers are still paying around a 5% coupon, and they have a lot of motivation to continue to stay in their home, but also if rates drop a point or two, they could be motivated to refinance or sell, given their age, given how much equity they have in their home. Some highlights of RMBS, and let me move over to here to full screen so you might be able to see it a little bit better. But we primarily are focused senior in the capital stack. About 55% of the mutual fund is AAA or better. Okay, that's current ratings. The bulk of that actually being agency securities. Agency securities have become extremely cheap in the last 6 to 7 months. The other 45% of our fund, which is in legacy assets, most of those were originally AAA. So we want senior bonds that are originally AAA, backed by first liens, where the borrowers have a tremendous amount of equity, comprised of primarily mortgages that are around a 5% coupon or higher. So those borrowers are actually motivated to potentially refinance. There is a high barrier to entry. One of the reasons we started the mutual fund is you can go on to Fidelity or Schwab or Interactive Brokers and buy a corporate bond. You can buy a municipal bond or a treasury or a CD, but they won't allow you to buy a mortgage bond. Even very sophisticated, high net worth individuals that might have an account at Goldman or JP Morgan, they won't sell you mortgage bonds. Most of our market trades over the counter still. There is almost no electronic trading like what is infiltrated high yield munis and corporates. In our market, that doesn't really exist. So one of the reasons we started the mutual fund is to provide access to a market that's traditionally hard to access. And we're trying to access a market that, if you listen to PIMCO, if you listen to Double Line, Guggenheim, Columbia Threadneedle, this is their best idea. It's been their best idea for the last 12 to 15 years. We're really just trying to isolate that and be a pure play investor in the RMBS market. Obviously, housing fundamentals are great. There's been 40+% home price appreciation since January of 2020. These legacy borrowers have seen 70% home price appreciation over the last 15 to 20 years. So fundamentals are great. Balance sheets are great, especially relative to corporates in corporate credit out there. One of the things we love about mortgage bonds, if anyone on this phone call has a mortgage, you make a payment every month. And when you make that payment, your principal balance goes down. Some of your payment is interest and some of it's principal. We as bondholders get the flow through, or they pass through, of that payment. So every single month, the bond that we own de-risks. So not only do the underlying borrowers de-risk, our holding also de-risks, because that bond holding usually amortizes. Because we're senior in the capital stack, and many times we have some subordination under us, those subordinated bonds aren't getting paid, whereas we're getting paid down every single month. We get upwards of about 20% of our money back per year from principal and interest. And one of the reasons why big guys out there love mortgage bonds. If anybody's read The Bond King about Bill Gross, that's really how he got to start. It's how he started PIMCO, is grossly overweighting mortgage bonds. I'm going to flip forward. We talked about a couple of these things, but just to kind of differentiate traditional fixed income versus mortgage bonds. Traditional fixed income is usually a bullet structure. So if you lend money to Greece, for example, you get an interest payment every 6 months. And then let's say it's a 10-year bond, Greece is supposed to pay you that principal at the end of 10 years. Whereas on mortgage bonds, you get paid principal and interest every single month. You don't have to wait every 6 months. Interest on traditional fixed income is primarily fixed rate. We're primarily floating rate. So a lot of the bonds we own, when they were issued, the buyers didn't want interest rate exposure, so they created a floating rate structure. So our mutual fund right now is currently about 55% floating rate. Traditional fixed income is usually priced around par. Even floating rate bonds out there like CLOs or bank loans trade within about 10 points of par. And so there is not that much upside per se if the borrower pays off at par. Okay, it might actually be downside because you don't get that coupon right. Whereas right now in mortgage-backed securities, almost the entire market is priced at a large discount to par. So you really want these borrowers to prepay, and we'll get to that chart here in a second. Tax treatment, traditional fixed income outside of municipal bonds is 100% interest. Whereas on a lot of mortgage bonds, because they trade at large discounts to par, there is a decent amount of profit that's actually treated as capital gains. So if you buy a bond at 60 cents on the dollar, every principal payment that comes in, 40% of that principal payment is profit and cap gains. Okay, borrower prepayment in traditional fixed income, I talked about, if they prepay, that's usually downside. Whereas in mortgage bonds, as most of these are trading at discounts, you want the borrower to prepay. And what we focus on, 5+% coupon bonds, these borrowers aren't in the money to refinance, but with 40, 50, 60% equity, they're not that far away from wanting to hit that button and refinance. If we look at our fund returns, we'll just focus on our institutional class up here. We're up to about 445 million in AUM. That's broadly based. It's primarily independent RIAs. We're not on we're not on Morgan Stanley. We're not on big wirehouses yet. We've focused on our bread and butter, independent RIAs looking to potentially replace their core or total return, but also right now looking to potentially complement or replace high yield, bank loans, so maybe more credit sensitive assets, as we view this asset as not being as credit sensitive. Okay, so since inception, RCIRX has returned 18.3%. The ag has returned negative 14.8%. That's 33% outperformance, around 11% annualized outperformance. Our beta to the ag is only 0.22. So we're very little correlated to the ag. We're not really correlated to traditional fixed income. Year to date, we're up about 380 through September 30th. As of today, we're up about 340. This is another bad month in the bond market. Bonds are down over 2% so far this month, and we're down roughly 80 bips. So year to date, relative outperformance is fairly on par with what we've done previously, which is about 5%. Here you have monthly returns. We were down 2% last year. We started the year at running a very, very low duration, but rates and spreads moved so much last year. Bonds, as most people know, were down 13. We were down roughly 2. Here's growth of $10,000 starting at inception. We've produced around $1,800 in profit, around 18%. Most of the bond market, we have a bunch of indices down here, are down. We're in a bad point in the bond market where we're staring down potentially 3 years in a row now of negative returns. Okay. So in our last webinar and in our last letter, we broke down what's happened since the start of last year and since the start of this year. Okay. So we produced, and I'll just focus on this right here. The ag since the start of last year through September 30th is down roughly 14%. We're up about 1.7%. Okay. We've put out tremendous carry. That is profit from principal paydowns and interest payments. We've made some money trading. We've made 116 basis points trading. Okay. Call it 60 basis points a year. But we've been dragged down by unrealized gains. And where have those come from? About a quarter of that unrealized is from interest rate movements. About 35% of that unrealized has come from spread widening. But the bulk of that unrealized gain has come from slower prepayments. As I mentioned earlier, we really want borrowers to prepay. Slower prepayments have hurt us, but that creates an extremely interesting entry point currently. Okay. So just a couple of stats. This is as of September 30th, about 427 million. Fairly heavy cash position. We're sitting on 16 to 17% cash in T-bills, in some tips, in some treasury floaters. We have some really interesting ideas on the cash side. If anyone is interested in discussing that offline, alternatives to make an extra 1 or 2% versus bills and money markets. Average loan age, about 14 years old. So these borrowers have been in their homes for 14 years now. These assets are only about 6% delinquent. Okay. Every yield that we talk about here is loss adjusted. We're already defaulting all of those delinquent loans and then some. We're defaulting upwards of 10% of loans in our analyses. Okay. 55% of the bonds we own are floating rate. 91% of the bonds we own are senior in the capital structure. We're running a rate duration, or what's your correlation to rates moving up and down, of about 3 years. Our spread duration, which is our correlation to spreads moving up and down, is about 2.6 years. Okay. Year-to-date return 380. Best month up 5. Our worst month ever is down 120. A really bad day for us, with us being down 30 basis points. I think that was earlier in the week, and the bond market was down roughly 1 that day. Let's look at outlook, and I'd rather go to some charts to really better describe what the outlook looks like. Okay, so let's start with current loan to value, because this is extremely important when you think about, do I want to be investing in mortgage bonds or corporates or high yield or maybe bank loans or CLOs? Okay, loan to value, the inverse of loan to value is home equity. There's never been as much home equity in the United States as there is at this second. Loan to values have never been lower. That's your entry point. Well-capitalized borrowers that have been in their homes for 17 years have 60% equity in their home, and they're only making $1,400 or $1,500 a month payments. Okay. Default rates, 1% a year. Only about 1% of these borrowers are defaulting per year. Okay. That's all the way back to about 07 levels. Okay. Let's look at spreads. this is agency spreads. So you can go out and buy U.S. government guaranteed agencies at about a 1.85% spread over U.S. Treasuries. That's almost 7% yield on government guaranteed assets. And again, if you want to talk to me about ideas of where to put cash potentially, that's an idea. And we prefer agency floaters. You have very little interest rate exposure. So you can buy agency floaters right now at almost 200 spread over treasuries, over 7% yield. That spread is on par with where we were on March 23rd of 2020. Probably the worst day I've had at Regan is that Monday during COVID. But you have to go back to 08, 09, when spreads got out to about 225 to put it at a worse moment than we are right now. And to compare that to corporates in this chart here, here's agency spreads. Corporate spreads, the red here is investment grade, the blue is high yield. Corporate spreads have been very benign, okay, in terms of sell-offs or in terms of implied risk. Why is that? So you look at right here, this is when the government said they're going to stop buying mortgage-backed securities. The government was roughly 30% of the bid in MBS up until this point. Okay, big widening. Then Silicon Valley Bank blows up about right here. Okay, then you also have the when the government almost defaulted. That was May 30th. So we're about to there. We're back at COVID levels. We're at really crazy levels here. Okay, I call these our spreadometers. So prepayments have only been lower 3% of the time. Borrower equity has never been higher. Spreads have only been lower in this very long history, only 10% of the time. And we're looking at defaults coming down towards 07, 08 levels. They should just continue to come down. Okay. Just looking at the characteristics on our mutual fund here, again, loans are about 14 and a half years old. Current loan to value is about 63%. 91% of these bonds are senior in the capital structure, AAA and better. 8% current credit support. Current loss adjusted yield, 7.8%. So that's after all defaults and losses are incurred that we expect. Okay. And one last chart here. We'll talk about housing. One of the big questions we get is well, what happens if housing goes awry? What happens if we'll cover housing here and we'll cover unemployment/recession? Okay. So if you take a loan that was originated in 05 through 07, and you look at the growth in U.S. housing between that year and the end of 2019, housing only went up 15 to 20%, about 1% per year. Folks forget that housing didn't trough until, early 2012. So it wasn't until 2012 where we hit rock bottom. Then slowly climbed back up to only average 1% a year. From January 1st of 2020 through today, housing's up over 40%. So these borrowers have 65 to 75% home price growth since when they took out their loan. That's insane. And I like to characterize this if when you're talking to clients about this relative to corporates or munis, and to get an update on corporate borrowers, you may have to sit into their quarterly conference calls, or maybe you have to call the treasurer of Cuyahoga County to figure out what the financials look like of that municipal bond you might be invested in. But to put an analogy around that, imagine you and your neighbor moved in to $300,000 houses 17 years ago. And you each call it 20% down. You put $60,000 down. So you had a $240,000 mortgage. Now your houses are worth $500,000. Okay. Now let's say your mortgage has been paid down to about $200,000. So you have a $200,000 mortgage versus a $500,000 home. Okay. We're buying that $200,000 mortgage for, call it 70 cents on the dollar. So we're buying that for $140K, and that $140,000 investment is backed by a $500,000 loan. We're getting monthly updates on whether or not you're making payments, what your new home value is. We get paid every single month. We're into that loan for $140K, but every payment, because we bought it at 70 cents on the dollar, every payment's 30% of that's profit, plus the 5% coupon you're paying us. Okay. So to think about, how would that go awry? Housing, that home value would have to go from $500,000 to less than $140,000, which is our investment. We're talking about a 70% decline in housing for this asset to really be at risk. Okay. Well, what about inflation? Well, we want home values to go up. We want inflation. What about a recession? What about if people start losing their jobs? If you lose your job, unemployment's at like 3.7 right now. Let's say unemployment goes to 6. If you lose your job and you have $300,000 in equity in your home, and you have the choice to sell and maybe rent or move closer to your kids in Florida or what have you, there's a good chance you sell. So we actually really want that borrower to refinance. We really want prepayments. Okay. So let's go back to this chart right here. So this is 6-month prepayment rate. This is on an annual basis, what percentage of borrowers refinance or pay off their loan. That can include moving, dying, getting divorced, etc. So we were just at about an 18% prepayment rate. Today we're at 6. Only 6% of these borrowers are refinancing or paying off their loan per year. That's your entry point, assuming that only 6% will prepay for the next 15 years, i.e., on average, these borrowers are in their homes for another 13 or 14 years after they've already been there for 17. That's your entry point. So we really want these borrowers to prepay. They have a ton of equity in their home. They're hitting life stages. And on average, these borrowers are paying about a 5% coupon. Okay, so they're not that far away from potentially refinancing. So this is kind of a counter-cyclical asset class in fixed income. We only have a quarter of the correlation versus the ag or traditional fixed income. About 55% of our book is floating rate, so we kind of want rates to continue to go up. But also, if rates drop a point or two, all of a sudden these borrowers are going to refinance at a much faster pace. So I'm going to stop there. We have a question came in already. Here's some stats on, I'm going to look at this. I'll leave it on this page right here. Here's some stats on the mutual fund. We capped this, I think, at 120, 121, but this is what we have to display as a 131 net expense ratio on the institutional class. The investor class is about 155. Some data down here, and I'll get to questions here. Why are you holding so much cash? Are you waiting for more banking sector stress? Other reasons. So we did an analysis of what happened to our MBS mutual funds in 2020, March of 2020. And on average, our MBS mutual funds in 1 month had an 18% redemption rate. Last year, 40% redemption rate. Okay. So we do this across everything, what we're doing, $1.1 billion in total AUM. $450 million is in the mutual fund where we offer daily liquidity. If we're going to offer daily liquidity, we want to be liquid. And so that's kind of half the battle. The other half of the battle is agency paper and AAA paper, which is also very liquid currently, is actually really attractive. And on a risk reward basis, pairs up really well with that legacy asset, that 15, 17-year-old asset. So part of it is we've seen what's happened before, and I would estimate we've done the work too. In March of 2020, when funds were a forced seller, it added 4 to 8% of losses. So they were down 10% on a mark-to-market basis that month, but many funds were down 15 to 20 because they were forced sellers. They had to crystallize those losses. So it's a question of maybe we're giving up a point a year to protect us against an 8-point loss from being a forced seller. That's a good hedge for us. And we're not just putting our cash in a money market fund. If you look at our top holdings, it's mostly T-bills, it's TIPS. It's very actively managed that we ourselves aren't paying management fees to someone else to manage our cash for us. And that's something to pay attention to if you all are invested in ETFs and mutual funds. Where are they putting their cash? How much are they paying a money market fund to invest that cash for them? Because it's not that hard for money managers to manage their cash position by themselves. It takes about 3 clicks in about a minute to actively reinvest T-bills or TIPS or treasury floaters on a daily or weekly basis. Is there any other questions? How high would you take rate duration in the fund? So I'm going to go back to duration here. We're currently at about a 3-year duration. So, and we were at 0.5 starting last year. So here's my rule of thumb. If you're yielding 7.5%, okay, and we're looking at, sorry to bounce around, about 7.8% here, okay. The maximum duration I want is roughly half of that, about 3.9 years, okay. Why? And I'll make the math a little easier. If we're running an 8% yield, why would we max out at a 4-year duration? Because I want to be able to survive, and I want our investors to survive, a 200 basis point move in rates. If you have an 8% yield and rates go up 2% tomorrow, you lose 8%. But now your portfolio is yielding 10%. So you're actually going to get that loss back in about 10 months from now. So that's our rule of thumb. We've actually been keeping it closer to about a third. Okay. So we were about 7.5% yield running 2.5-year duration. Maybe we move it up a little bit. You know, if you ask me for my forecast on interest rates, I tell folks I have the smallest crystal ball in the world. We're not here to predict interest rates. But what I'll say is, we're getting mightily close to a flat curve where you can put money to work on the short end at about 540. You can put money to work on the long end at 5 or better. Okay. So the 2s to 10 curve is only inverted about 26, 27 basis points. When that curve gets flat, when that curve steepens out a little bit, all of a sudden, pensions, insurance companies, money managers will come out of T-bills finally, might come out of equities, because now they can lock up a 5+% return for a long time. Add on to that some interesting plays like what we're proposing, where we think you can yield 7.5, 8, 300 basis points over treasuries. And that's going to move a lot of needles. Okay. If you're an endowment and foundation and you got a 5% payout ratio, do you want to buy T-bills at 540 or do you want to buy 30-year bonds at 505? If I'm an endowment or foundation, I might be putting some of that money into some duration to lock in that payout for an extremely long period of time. This is I call it a once in a generation opportunity, but you legitimately have to go back almost one generation to get to these yields. One generation is 20 years ago. You got to go back, 16 years. Any other questions? We're right at 31 minutes. And so I want to be mindful of people's time. Cool. Well, thanks for everyone for attending. We will send a follow-up recording and deck. Please reach out to us or ir@regancapital.com. If you want to discuss anything offline, I'm here, I'm open kimono, and I'm available. Thank you.